Markets are lower to start the year. This after the S&P closed 2023 with its best weekly winning streak since 2004. My next guest maintains his bullish outlook for U.S. stocks and a few areas outside the U.S. as well. Let's bring in John Mowrey of NFJ Investments. Happy New Year. Welcome back.
Happy New Year, Scott. Great to see you.
You as bullish as we enter a new year?
I still remain bullish. I will say at the end of 2022, you had very depressed prices really across most parts of the equity market, particularly cyclicals. Today, Scott, I think that investors would be wise to be positioning a little bit differently. We've talked about moving down the cap scale. I like small caps. I like mid caps. We can discuss that. But I also look at our portfolio today, and we're building it on a bottom-up basis, Scott. But it does look pretty different than it did at the beginning of last year. We're overweight staples. We're overweight REITs. We're overweight banks. We're overweight some of the utilities. So all those areas that are tied to interest rate sensitivity, more bond proxy areas, those look attractive, Scott, and we are underweight big tech names, some of the semi names. Those have gotten more rich from our perspective.
What kind of year do you think those are going to have first? I know you said you're underweight them. Put that into real terms about what kind of year you think they're going to have. Ask you, of course, and just to remind our viewers, NASDAQ's down by a little more than 2%. So we do have some kind of movement going on within those areas that you speak of.
Well, just to contextualize this, the S&P just put up its top 5 calendar year return over the last quarter century. That is material. The NASDAQ 100 just put up its best year since '99. So, when we look at large tech, posting a year like that is pretty substantial. You've had a lot of multiple expansion, Scott. The one thing that big tech does have going for it is it has a lot of earnings growth and it has a lot of recurring revenue. Recurring revenue garners higher multiples, and those companies also have very, fortress balance sheets. But I would argue that I think the returns are going to be much more muted, Scott. I think it's very plausible that you get positive returns in the S&P 500, so I would be bullish there. But I would be much more bullish as I look down at small caps and mid caps, particularly value, Scott. We're starting out the year on a pretty big note for value. You're seeing, the RLV, the 1,000 value ahead of the 1,000 growth by nearly 150 basis points, the same in the small and mid cap arena. So we're seeing a pretty substantial rotation there. And if you look outside of just the broad value indexes, regional banks, which is an area that I know that you and I have discussed throughout last year, those are now beating the S&P 500 by 1,700 basis points over 6 months. So they're not as cheap as they were 6 months ago, but they're still historically cheap. And I think investors need to be rotating out of many of the larger cap growth areas and looking down the cap scale and its cyclical value.
What happens if the economy, inflation, and the Fed don't go according to plan? Because everything that you've said about what you like and what you don't is baked on the idea that it does.
Well, what gets me so fired up about some of the bottom-up positioning we're seeing, Scott, is you get to play offense with defense. Utilities have gotten cheap. Staples have gotten cheap. REITs have gotten cheap. Banks have gotten cheap. So you're seeing a lot of areas that historically, other than maybe banks, looking a little bit more reasonable on valuation because look, the reality is investors made a kind of a barbell decision last year. They said, okay, we're going to pile into fixed income to clip coupons, and we're going to pile into large growth to try to get equity returns. That has left a real opportunity in areas that have yield, growing yield, and they're still deeply discounted. So what gets me excited, Scott, is that if we do get some choppy months and quarters, which I expect we will, as we always do in equities, you get to play some defense with utility staples, REITs, those areas like healthcare. Those look attractive today.